We're now going to be looking at next learning objective, or next goal, is to show you how we use journal entries, T accounts, to record transactions. This is the real deal. This is the way it's done. Although it will be done electronically, this is the bookkeeping type of representation of what's happening in a company's information system. Now we're going to have to learn the rules of debit and credit. Now normally, I normally don't tell you to memorize anything, but you got to memorize this. And this is where, when we move into intermediate, we have to expect that, when you go to auditing in the fall, everyone's going to expect you to be able to snap off journal entries, no problem at all. So you can't, downplay this as a mechanical tool. It's a tool. You need it to work. Okay, so here we go. We're going to be using T accounts. Now these are graphic representations of individual accounts that are in an information system. It could be a file somewhere in the information system. It could actually be, manual. Debits and credits are listed there. So the left side of the account, of course, is the debit side. The right side is the credit. The debits and credits, of course, are there just based on convention. It doesn't mean, for example, that it's like a debit card if you worked at a bank, or if you start thinking about a credit card here, it could be a problem for you, because again, banks have the total opposite, so that it just messes things up. So just start from the beginning if you have any experience here. This goes way back to 1494. Everyone knows, I think the system was created by a monk, Luca Pacioli, in Italy somewhere, and that's been used since 1494, so we're not going to change it. So got to remember that an account, a T account, is in the form of a T, not exactly what you would see in a company's actual ledgers. It's not what it would look like in the company's information system, but it's a useful device. Anybody that works anywhere in accounting and finance and statement analysis will, if you go to a meeting, people will be sitting there just putting T accounts down and analyzing transactions. So it's a useful device to be used to analyze transactions. Now, it doesn't mean increase or decrease. It depends on the type of account. But simply means debits would be entered on the left side, credits on the right side. If debits exceed credits, the account has a debit balance. When the credits are larger, it has a credit balance. Now, you don't know whether you increase an account or decrease an account with a debit or a credit until you know the following. And these are the rules of debit and credit. So you've got to make sure that we memorize these immediately. You notice that to keep the equation in balance, not only are assets equal to liabilities plus equity, but debits have to equal credits. So on the asset side, you increase an asset by a debit and you decrease it by a credit. So if cash goes up, you debit the cash account. If accounts receivable goes up, you debit accounts receivable. If accounts receivable goes down, you credit that account. On the liability side and equity side, the effects are just the opposite. They increase by credits and are reduced by debits. So if I wanted to increase accounts payable, I'm going to have to credit accounts payable. If I increase equity by issuing new stock, I have to credit the capital stock account. If I pay off a liability, I'm going to reduce it by a debit. So these are the basic rules of debit and credit. Now what gets extremely confusing that you have to keep in mind is when we work with the revenues and the expenses. And I'm going to try to spend some time on that right now. There's not much I can do here except to tell you this is the way it is. Normally they don't say that. It's rare. They never say to you, that's it, can't say anything else. And you've heard a lot of instructors will say that, well, do it this way. Why? Well, that's the way you have to do it. Well, this is the only time I'll say that. There's nothing else we can do. But where it becomes important is to know something about the accounts. So we call a normal balance is something that you would expect. So accounts that increase with debits would have normal balances of debits. So if you're auditing and you see a cash account with a credit balance, that's a red flag. That's something that is unusual. It's not the normal balance. or if you see an accounts receivable with a credit balance. That is not expected. On the liability side, if a liability has a debit balance, you know there's something wrong there, right? Or maybe something wrong. So that you have to understand the normal balance. A normal balance is simply the side that increases the account. So if an account increases with a debit, that's its normal balance. That's what you would expect to see. If it increases with a credit, that would be its normal balance. Now, the problem comes in is when we break up the equity accounts. The equity accounts have to be analyzed a little bit more carefully. Equity accounts include contributed capital, retained earnings, revenues, expenses, and even the dividends in some cases. So here's where the equation gets a little bit tricky. Because stockholders' equity is made up of dividends, revenues, and expenses, and of course, common stock. Common stock would include additional paid-in capital as well. So we know that on the equity side, and I'm going to explain this a little bit differently in a second, but we know that on the equity side, equity is going to increase with credits and go down with debits. So when you look at common stock and revenues, let's just take common stock and revenues for a second. When you look at common stock, that's kind of friendly, right? Because if common stock goes up, it's credited, and that increases equity. So it's consistent. And if revenues go up, they increase with a credit, and we know that they increase equity as well in general. What becomes a little problematic would be dividends and expenses. So when we say that dividends go up, we're actually reducing equity. So dividends are debited for the increase. Expenses are the same thing. If an expense goes up, it is debited, but you have to make sure you understand that that is reducing equity. Now, the way I like to show it is like this. So for me, I'd rather kind of have a giant, like stockholders' equity account. And it shows you that on the credit side, which is the consistent side, so if I increase equity, I'm going to credit that account, right? I credit equity to increase it. Anytime I increase a revenue, I'm going to credit the revenue, and it increases equity. Every time I increase contributed capital or additional or other comprehensive income, I'm going to credit those accounts, and they increase. The problem is here on the expense and dividend side. Expenses and dividends are going to go up by debits, but when you debit an expense, you're reducing equity. When you debit dividends, you're reducing stockholders' equity. Now, I don't have retained earnings here because it's made up of revenues, expenses, and dividends. So maybe this helps. I hope it does. It gives you a visual of how the T accounts are really part of stockholders' equity. So revenues are part of equity. Equity goes up with credits. So do revenues.
Can you explain why there's no T account for retained earnings?
What was that?
Can you explain one more time why there's no T account for retained earnings?
Yeah, because in the retained earnings account, you would have, it would actually cause another, and we would have to do this separately because it's going to be something like this. In here, I would have to show you the retained earnings account. And in the retained earnings account, this is stockholders' equity. In the retained earnings account on this side, I'd have expenses, right? And on this side, I'd also have dividends. And here I'd have the revenues. All right, so I know revenues go up by credits, down by debits. I know the expenses and dividends both go up by debits and reduced by credits. So this, again, is on the credit side. Retained earnings, we would hope, would have a normal balance of a credit, and it's really captured with the revenues, expenses, and dividends. That's what. So you could have a separate retained earnings account for that as well. And I'm assuming you want to have retained earnings on the credit side of stockholders' equity. So this is how the retained earnings account would look. It would increase with revenues. It would be reduced by expenses and dividends. So the question is, I didn't show, by the way, this is all the comprehensive income. Let's just leave this here for now. Because I said we will get back to that. All right, so again, whatever helps you, I'm going to show you a couple of more devices right now. Whatever helps you with this, it's going to take practice, obviously. The more you do of these questions, the better prepared you will be to make the journal entries. All right, but I don't know if are there any, I mean, there's not much we could say, but that was a good question. But do you have any others with respect to these effects? All right, now, just some other devices that you could look at. Again, devices to help you memorize. The next one I got here is really everything. The other comprehensive income, I'm not sure what to do, what its normal balance is. So you can just go ahead and think of other comprehensive income like retained earnings that are increased by a credit, decreased by a debit. And again, whatever you want to use to solidify your ability to sort of work with debits and credits quickly, that's absolutely up to you. Okay, so there's lots of different ways you can do it. Now, let me just show you an example, and then we'll go back to any questions you might have. So if I'm looking at the cash account, I've got a beginning balance, and you would expect cash because it's an asset, and you're going to see a lot of this notation. Obviously in a bookkeeping system, this would be perhaps a date, or this could be a reference to a journal entry, which I'll show you. The cash account has an A next to it. We're always going to remind you, that's what I really, really like about this book. It always reminds you the type of account. It's an asset, it's an equity account, it's an expense, it's a revenue. So cash is an asset account, increases by debits, decreases by credits. Opening balance. The opening balance, and again, we said those are the abbreviations for the account, asset, liability, or equity, and of course the transaction flow. This account started with a beginning balance of $2,500. Where did that balance come from? That balance was the ending balance from last year. Cash accounts are on the balance sheet. Remember I said the cumulative accounts? I mean, you may be memorizing that the balance sheet is a cumulative statement, but that's what it means. It means that these balances carry over period after period. How did cash increase? It increased maybe by cash sales, maybe by collections, and those are debits. Credits, how does it decrease? Paying off liabilities or incurring expenses. So the change in cash plus the opening cash balance will give you that ending balance. So the ending balance now is the ending balance for this period. But what you have to remember is that next year, the beginning balance next year, let's say this is 2017, is $3,700. And this was 2016. So the balance carries over period after period. Carries over period. So we're going to start to look at transactions. We'll do a lot of them today, I'm sure, but that's the way it would be reflected in the TA. So any questions on the cash account? We'll do a few more of these, obviously. Now, not exactly the way we do it. We don't record in the T accounts first. We normally record first in what is known as the journal. The journal then would post the ledger. So the way the transaction flow works, and you've probably seen this in the textbook, is that the cycle this accounting cycle could take place, parts of the cycle take place at different points during the year. So the first thing you would do is have a transaction analysis, so whether or not you're going to record something. So that, for instance, if somebody signs a contract for employment, you don't record it until that person starts getting paid. So that's not a transaction that would be recorded. Selling merchandise would be a transaction that would be recorded. When we analyze the transaction, we have to determine its effects on the financial statements. When we determine the effects on the financial statements, we journalize. And we're going to use a general journal. The general journal is the book of original entry. Now, there are a lot of special journals that companies could have. I mean, it's very easy with a computer system. So if you wanted to look up, let's say, a salesperson's commission, you could have a commissions journal. You could have a cash receipts journal. You could have a cash disbursements journal. We're going to use a general journal. The general journal is the book of original entry. So we record first in the journal. It's the book of original entry. We record in the journal first. That keeps the transactions in chronological order, and it also keeps the transactions in one place. So if you ever needed to research an effect on cash, an impact on accounts receivable, you would then be able to see that in one place. Then, if we wanted to get these to the T accounts, we're going to post these to what is called the general ledger. The general ledger is where the company has all of the accounts of the business. All the T accounts, for example, are there. Cash, receivables, in it. So this is the part of the cycle we're going to be looking at probably for the rest of today. We're going to analyze, record, and then post to the general ledger. Now, I will tell you that from the general ledger, you get the information you need to prepare financial statements. And that's where we're going to go at some point. So the benefits of going in this order or using the journal first, by using the book of original entry, initial recording in the journal, as I said, it keeps the transaction intact, it is in chronological order, and it helps you to locate errors. If your balance or your books don't balance, you can go back to the original transaction, and you'd understand whether you have a debit that doesn't equal a credit or something like that. Or you might have used the wrong account. So let's say you've got a transaction that says paid wages, and you see a debit to prepaid rent and a credit to cash. It's a mistake. And you'd find that out right away by looking at the general journal. Now, from that, of course, we're going to wind up, after we journalize, and of course, if you have more than two accounts, it's called a compound entry. By the way, the example we had with the interest, when you paid $4,040, principal plus interest, it's a compound entry. So more than two accounts, a compound entry. Once you've journalized at the end of a period, or maybe immediately, you're going to post that to the general ledger. So eventually, we're going to break this transaction up and we're going to post it to the general ledger. And for us, the general ledger is the book of final entry. It's the last place that it's going to be. So here's an example. And again, what I really keep emphasizing is that always look at these abbreviations, because it'll always help you. We know that cash is an asset. That's easy. Sometimes it's not that easy in certain transactions. But in this case, this is the example we had early on. We did this last week. And again, we said that we had a transaction when you started your business, you raised some capital with an initial public offering of $10,000. So you increased the capital stock. and you increase cash. Now, we're not going to be doing much with the T account, or with the equation, but we now will be using the journal entries. So, cash is an asset account. Assets increase, they increase by a debit. So I know I have to debit cash. Common stock is a stockholder's equity account. Equity accounts increase by credits, and I know I have to credit that account. So what we are now reflecting is that when you go to the accounting equation and you increase cash and increase common stock, what you are doing in effect is increasing the asset cash by a debit in the journal and increasing the equity common stock by a credit. Now, again, that's in one place. That takes place on day number 1 or transaction number 1. However, in order to start accumulating these balances, we have to post these to the general ledger. So now we break the transaction up. And in your computer system, you may have to drill down to find stockholders' equity. You might have thousands of accounts. So cash is kind of up front. You may have to drill down quite a bit through the chart of accounts to find the stockholders' equity. So we are going to post these now. And the posting would now move. And by the way, there could be a reference here. We're not doing the full bookkeeping. When you take the courses, I know you have one in information technology. Next summer, you get the course in accounting information systems. There's lots of cross-referencing coming through. So cash might be account number 101. Stockholders' equity might be account 510. So those references would be there, and they would be linked through that computer system. So that is the process of going from the general journal into the general ledger. Now, this is the format. You have to be very careful. One of the things, and by the way, I will tell you that you've got to have the specific accounts. And it happens a lot at the undergraduate level, but it's not, graduate students are not immune from this problem. Gee, I should get credit because I debited assets and credited stockholders' equity for $10,000. That's not what you need to do. We need to have specific accounts. Specific accounts have to be identified. The source of cash has to be identified. So I need to know it's the assets cash, and I need to know that the source of cash was common stock. And as obvious as that may sound, I've seen exams where somebody's got an expense and they debit retained earnings directly. You can't do that. So it's got to be coming from a specific type of expense. And the format has to be exact. We'll talk about the format in a second. And I would reference, even if you're doing something in paper and pencil, I know everything's done on computers. I am going to be doing more exercises in the class with paper and pencil because that's the way the exams are going to be taken. You may not have a drop-down menu, which makes the CPA exam is like that, but it doesn't help you if you're at the client. There's no drop-down menu. You got to work with the client accounts. So we'll do more of that. But what I want you to notice is the format. So here's the journal entry. On May 1st, we have the stockholders contributing $10,000 and for exchange for 500 shares of common stock. Notice a couple things about the format. Number one, you have to have debits recorded first, and it is kind of in the left column, and credits are indented, and the amount is to the right. And I'm going to be reading these things, or if I have somebody grading them, that's what they'd expect to see. I mean, and there's the other thing too. You got to give me credit for this. You set up this entry, and you got cash this way, and you got like common stock like this. The wrong way. You indent the wrong one. When I'm looking for, and the numbers are in the right columns, but my eye goes here first, and I see that common stock is against the margin, you got cash indented. I'm like, well, or if you do this, if you put the common stock first and then the cash second, even though it's right, if the entry's flipped, it's going to be hard to grade, and it's not correct. So when it comes to the bookkeeping side of this, it's got to be done this way. Debits always come first. Even if you got more than one account, you got a debit. Those come first, left-hand column, and you indent and that's against the margin, and you have to indent the common stock. So again, that is just basically a convention. If you were working with a manager and the manager asked you for a journal entry, that's the way it has to be presented. All right, and then when you post it, of course, same thing happens, where debits usually get posted first, and then the credits in those individual accounts. Let's see the next one. You now have a loan. You borrowed $4,000, and you're going to repay the loan at the end of the month with the $40 interest, but this is where you borrow. Now again, we can do this on the equation if you want. Just at least one more time. So you borrowed $4,000 in cash, and you have no payable. So if you're analyzing the transaction, this is the way you would analyze it. The transaction analysis says that I've got a liability of $4,000, so I increased notes payable, and then the asset cash increases. But now translating that to debits and credits, you're going to debit the asset cash, and of course credit the notes payable. And once again, debits on the left side against the margin, the credit is indented. Once again, the notation, making sure you know it's a liability. Eventually you're not going to need that, but I think it's important to have that as a reminder. Now, there's no interest yet because the interest accrues at the end of the month. Questions? And we're going to go through a lot of transactions. Just want to make sure you're comfortable. These are all the same transactions. All right, now, security deposit. Question came up whether or not that should be prepaid rent. This book says security deposits sit there as assets, they don't get amortized. So if you have an apartment and you have to put down $1,800 rent, or I should say deposit up front, that does not go to your rent expense unless you walk out without paying the rent, then they take it. But there's no expense here, so we're going to call it an asset. It's not a prepaid asset, unless it said prepaid. So this 1800 security deposit, you're going to debit the asset security deposit and reduce the asset cash. And again, the first thing you would do, if you're not sure, is go to the equation again. So if you want to make sure of the effects, so we know that the equation is going to balance. Assets increase by 18, so we debit the security deposit. Cash goes down by 18, so we credit. And that's what you're seeing there, and then we post them to the tables. So the transaction analysis, if you want, you don't have to, but it kind of starts with the equation. And at some point, I'm sure very soon, you're not going to be using it. So, any questions? Yes.
So just with the security deposit, like let's say you damaged the store and they never gave it back, at that point you would transfer it to an expense?
Yes. Yeah, if there was any damage and you had to bring it back, it would be an expense. So what would you do? You would debit the expense and credit the security deposit. All right, so does anyone have any other questions? I mean, I don't want to just keep running through these, and if you want me to stop, if you've got it down pretty well.
Just to get an idea, the process itself, is this something that takes, maybe do it by the end of the year, so we start at the beginning of the year, and then we
Yep.
post it by?
Yeah, this can be done, I think I mentioned this, but I wasn't clear enough, I'm sure. When I said that this can happen at any point in time during the year. If the transaction happens here, once that occurs, you analyze it. Now, in a computerized system, it just flows right through.
Okay.
So the journal and the posting and the effects on the accounts happen simultaneously. Well, let's say it's a manual system.
Yeah.
You might do all your journal entries, and at the end of the day, you post them. But posting will happen relatively soon after the journal entry.
Okay. So once you journalize it?
Yeah, you pretty much post it, yeah. And then, of course, the next step might be to do a trial balance and a financial statement. I mean, that can happen at the end of the cycle.
Okay.
Or the end of the week, or the end of the month. It depends on your cycle. Your cycle could be 1 month, it could be a quarter, or it could be a year.
And just follow, so like in Amanda's example, if we were to debit or credit like the security deposit, so we, I guess we debited it, I would go back to the system and I would credit it on the same area but below it.
Yeah, so what would happen? Yeah, good point. So we're going to see some of those in a minute where we've got
Okay.
an account, but good question. So let's just go through that and see what would happen. So let's assume that we had a problem. The store got damaged, and the landlord says, well, look, I'm going to take $1,000 on this, this month. What would happen? You would have, well, let's say we take the whole thing. You leave the store, comes in, it's damaged, and we're going to keep your security deposit. And you'd have some kind of repair expense, and you'd have security deposit. So this is an expense, which we haven't seen yet, but it increases the expense and it reduces stockholders' equity. And security deposit credit, we're going to reduce the asset. When that gets posted, expense plus expense minus stockholders' equity. When that gets posted, I'll use red here for that. So when I post I would debit the repair expense, and then I would credit the security deposit. It does not go below it, it goes on the credit side.
Okay, so it's,
Yeah. Now the balance is zero. That's the way it would work. If you, great question, because we're going to get to some of this. But if you were to put it below, that means you're adding to it on the
Right.
debit side.
so it's kind of like a convention, you can't mess up. Because if you do, someone can just read it.
Yeah, I mean, what happens, I mean, there's a lot of checkpoints with the trial balances, you make sure it debits equal credits, and there are a lot of checkpoints in the system. Okay, good question. Any other questions on this particular case? All right, so let's take a look at another expense, which would be advertising. Make sure this is cleaned off. So the next one is advertising expense, inventory, excuse me, inventory. So we're buying inventory on account. So you're increasing the asset inventory by a debit, goes to the left. or the margin, and the number goes to the left. Accounts payable is the credit that gets indented. Notice again the notation, increase asset, increase liability. And then when we post those, transaction 4 goes to the inventory account as a debit and accounts payable as a credit. So any questions there? And again, just stop me because these are going to get repetitive, obviously. Let's go to the next. Here's the expense. Advertising expense. This is what I wanted to show you, the notation. Always reminding you, that link, that I was trying to do earlier this morning, that anytime you have an expense, it's going to increase expenses, reduce income, and reduce stockholders' equity. So the debit to advertising expense for 900, which we did on the equation, is going to be debited to the expense account, and of course, we're going to credit the cash account. Okay, so that expense is coming out of cash. Questions on that? And again, the notation is important because anytime we increase the expense, we reduce the stockholders' equity. Yeah.
Why does the expense come first instead of the cash?
Which one is that?
Wait, why does the advertising expense on top and then cash on the bottom?
Because the advertising expense is being debited, it's increasing,
Okay.
and cash is being reduced, so it's credited, and that's why we
Oh,
indent it.
gotcha.
Yeah, the
Okay,
debits
that's
always
why
come
it's
first,
been-
then the credits, right?
Right.
I think I understand the source of the question is because both accounts are increased by debits. It's really what's happening to the account, not the normal balance. All right. And here's the inventory. And this is, again, paying off the liability. Now this time we're reducing the liability. Liabilities are reduced by debits. They come first. And we're reducing the asset cash by a credit. That gets indented. And then of course we're going to post those to the respective T accounts. So give me a minute to see if you have any comments there. It's a standard payment of any liability. But by the way, this gets very repetitive in a lot of ways because whether this is an accounts payable, a note payable, a wage payable, whatever the liability is, it's accounted for in the same way. And what you're going to find out, particularly when we get to intermediate accounting, there is a core of about 20 fundamental issues or concepts that keep repeating themselves. And they apply to different transactions. So whether that transaction is a lease transaction, whether it's borrowing money, whether it's buying an asset or building an asset, whatever it is, it's going to have a core principle that you could fall back on. And that's the whole purpose of the theoretical foundation, to make sure that you have enough ammunition in your accounting arsenal to handle unfamiliar transactions. Because what you don't want to be doing is just saying, I don't see it in the book, so I don't understand it. There's going to be a core, a fundamental understanding that you're going to have. All right, so now, this is the sale of inventory. And this is the question I had during the break. Expenses are normally not kind of tied to revenue like this. I mean, they are matched. The timing of expense recognition may not coincide with the revenue recognition. So I'll give you a perfect example. What if you had to pay a salesperson commission immediately to sell a health club membership? So we send a salesperson here. Well, let's say that for whatever reason, the building on Washington Park where there is a gym that we can't use, but maybe they might start selling subscriptions. So they come into this classroom, salesperson comes up here, sells you subscriptions, health membership. Let's say you can't use the college gym. I got to pay that commission at the end of this week. I collect those subscriptions from you. You start your gym membership in July. I recognize the expense first. On Friday, I'm going to debit the commission expense and credit cash. But when I collected your subscriptions today, I have a debit to cash and a credit to unearned revenue, which is a liability. So revenues and expenses may not coincide. may not coincide. So it only, and this is an important point, inventory payables and cost of goods sold, they kind of go together. So anytime you buy inventory, you can think of an accounts payable coming. So the way I think you should look at it is on an inventory purchase, inventory acquired on account, accounts payable. That's the only liability that you would use in that case. It's the only liability that you would use. They're tied together. An analyst will always assume that accounts payable relate to inventory. So if an analyst sees accounts payable on a balance sheet, they're going to assume it's related to inventory purchases. It may not be 100%, but that's the assumption. Then, when you have a sale, inventory is used up. And that's when you get the cost of goods sold. So that's the way you have to think about these transactions. Now, if you were selling something else, like a service, there may not be any cost of services. So it doesn't mean you're always going to get an expense immediately. So in this case, you sell, and we had these transactions before, this morning on the equation. You've got cash going up by $2,400 by a debit. You've got sales revenue increasing revenues and equity by a credit. Cost of goods sold is an expense. We debit that for $600, and we credit inventory for $600. And then when we post them, of course, they go to the appropriate accounts. So again, inventory used up is going to be related to the sales. All right, so any questions on that revenue? Again, I repeated the question I had during the break because I thought it was something that is in a lot of people's minds. Why is the cost of goods sold always tied to sales? And that's the reason, is it's the use of inventory. It's due to the use of inventory. All right, so now let's go through a few more of these. There's a sale, the second sale for $2,900. It's the same transaction. This time it's going to be a debit to not cash, but accounts receivable. And by the way, what this shows you, comparing transaction 7 to transaction 8, is that it's exactly the same effect, except that when we think of revenues, you have to think of revenues as either an inflow of assets or a reduction of liabilities. And when I mean a reduction of liabilities, I mean unearned revenue being reduced. So an inflow of assets doesn't say an inflow of cash. So in the first case, it was a debit to cash, credit to sales revenue. In this case, it's a debit to accounts receivable and a credit to the sales revenue. So same revenue, this case, no cash flow. All right, a couple of more transactions. Anything else on that? Let me go through the rest of these with you then and stop me. Wages. Every expense is going to look like this for cash. You debit the wage expense, credit cash. Again, expenses will reduce equity. All right, now those expenses, again, could have been related to the sale. I mean, somebody could have been in the store when you sold the product, right? Selling that product. Maybe not getting sales commission, but someone just working in the retail outlet, that person has a wage that has to be paid. Collecting accounts, the unearned revenue. So here's the example of cash coming in advance. It's a liability, so you debit the cash account because it's an asset. you credit unearned revenue because it's a liability. And then when you post them, that's the way it's here. And then, of course, the collection of receivables, increase the asset cash, increase asset cash by a debit. We reduce the asset receivables by a credit. Now, here's cash flow without revenue. Cash came in without any revenue being recognized, because revenue was recognized when you sold the product on account. All right, here's one, again, the interest expense when we pay the note. And this is your first compound journal entry. It's a compound journal entry because it's made up of more than 2 accounts. And in the compound entry, we have a debit to paying off the note payable for $4,000. We have a debit to interest expense and a credit to cash. Now the credit to cash is 40/40. The debit to notes payable reduces the liability account. And let me just go to, one of the things that we're not showing here is we're just showing you changes. But in this account, there was a balance of $4,000. Correct? I mean, if you borrowed the money, there was a liability sitting there of $4,000 when you pay it, and it has to have a credit balance. So the balance of the debt was $4,000, and when you paid it off, you debit that account, and now, of course, it goes to zero. The account is paid off. So the account's paid off with the debit to the note payable. I want to make sure that, again, we're going to see like more the full accounts in a bit, but anyone with any questions on this particular case? Because you started off with a loan of $4,000. When you pay it off, it's going to be, in this case, debited, and it brings the account to zero. Brings the account to zero. All right. Let's just go through the rest, and then summarize in a minute. Prepaid insurance, one asset goes up by a debit, we credit cash. In this case, the asset is prepaid insurance. Now remember, we said that, we didn't show you that here. Let's go back and let's get that example up here in a second. Yeah, here it is. Okay. So here's the prepaid insurance. Oops, sorry about that. Prepaid insurance. What I want to do is let me just finish this one, and we will break. I know I'm a bit 5 minutes off. But when you look at the prepaid insurance account, that's for the initial purchase. Debit that account, credit cash. What would you do in the month of June? How would you record the expiration of that insurance? So you notice, we know what happens, right? That's the whole point of the transaction analysis. I know that I used up 200. And I know that I should have a balance of what? 6. And that's the whole idea. I know, doing initially mechanics and analysis may sound a little, counterintuitive, but you got to put them together. And what would you do? What journal entry would you make here? Let's say in June. What would be the journal entry to record the expiration of 1 month's insurance? It's a 4-month policy. What would you do? Anyway, good. Or again.
Expense.
Right. Insurance expense.
Yeah, for 200.
Right.
And then also prepaid insurance,
Right.
minus assets for 200.
Right. So the debit side and the credit side. So here you have an expense that goes up, and you reduce stockholders' equity. Here, asset is going to go down, and that's going to be for 200. Journal entry, debits, insurance expense, credits the prepaid insurance. On the T accounts, and I'll leave you with this one before the break. Insurance expense is going to be debited. This is for June. 200. We're going to credit prepaid insurance, and the balance is 600. Right, so modifying this a little bit and taking it one additional step shows you how to build. Now we will go through examples like this. I mean, today we're just kind of drilling the debits and credits in. Well, I like to do this every once in a while, especially going back to something we did earlier today. So that would be what you would do for this particular insurance policy 1 month later. Notice the prepaid had the cash outflow in May, but the expense in June had no cash effect. All right, so let's take a break here, maybe 10 minutes. And this is, again, this is not done. We talk about tricks and things. We're not trying to trick you. Some of the homework you know is tricky. But if you read this carefully, you have to be very cautious with respect to detail. This one said paid $800 for a 4-month insurance policy. The next transaction, 14, says they paid $700 rent for May. Now that means that they paid rent for the month and it's going to expire. So in other words, if you paid $700 here in May for the month of May, you know it's going to expire. So that you might as well record it as an expense immediately. So you just have to watch the language, and that's just going to come with doing a lot of these questions. So here you debit rent expense, and then of course you credit card.
Not that this is not a likely scenario, but let's just say your cycle was 2 weeks, then would it still apply like that, or would it accrue?
Yeah, it depends on the materiality, but I mean, if you were following a strict bookkeeping regimen, and you paid this on May 1st, and it expired at the end of May, you have an asset, and then you have to write it down. But that becomes inefficient from a bookkeeping perspective in a lot of cases. In fact, what a lot of people will do is essentially take a 4-month policy, a 6-month policy, even a 1-year policy, and probably expense it all at once if they're not reporting periodically. So it really depends, but you're right. I mean, it depends exactly on when this was paid, but the language here is designed to expense it. All right, dividends. In this book, dividends come directly out of retained earnings. Other books would have an account called dividends declared that gets closed out to retained earnings. This book decided to debit dividends directly. So if you pay $400 in dividends, it is a debit to retained earnings directly and a credit to cash. And as I said, this would be a cash flow from financing activities. We're not using a dividends declared account. So in summary, if you would have posted all of these and take a good look at this and follow the transactions through, what I would recommend is following all the transactions through, looking at these account balances. I already did the payable for you. Where it started off with a balance of $4,000, you paid for it, now it has a zero balance. The retained earnings account has not been updated yet, and there's a reason for that. But you have your expenses accumulated, your revenues accumulated. Your revenues we already saw earlier this morning were $5,300. That represents 2 sales, $2,400 and $2,900. So I would just recommend following this through, looking at all the postings, and then looking at the summary set of statements. All right, so the next thing we're going to have to do, and we do that in the next chapter, is ultimately get all of these income statement accounts closed out to zero, because that has to start next year with a zero balance, and get those balances into retained earnings. And that's the closing process we talked about earlier today. And that's the articulation link. Although we don't see it right now, we're not showing you that link now, but eventually all of these revenues and expenses have to get into the earned capital. It's gotta get in there. And they have to start next year with a zero balance.